everyone. It's Andy Panko, owner of Tenon Financial, moderator of the Facebook group Taxes and Retirement, and content creator here of the YouTube channel Retirement Planning Demystified. I wanted to discuss with you all some recently proposed tax increases that just hit the wire, so to say. The House Democrats had just put out a proposed set of legislation regarding pretty wide sweeping income tax rate increases, mostly focused on corporations and high income individuals. Now, it's been no surprise since the beginning of the Biden administration that there was a focus on increasing taxes. But from the beginning of those discussions and talking points, it was clear that the intention was to raise it on corporations and high income individuals, though those things weren't specifically defined. And also up until now, all the items that Biden discussed or that were otherwise kicked around within the political spectrum were really just talking points and sound bites. Now there's actual legislation that's been put forth. It doesn't mean it's law yet, but there's nonetheless, pen has been put to paper. There are some things, there are some actual proposals that are now going to make their way through the legislative process and maybe eventually end up becoming law. So now that things are a little more tangible, some of these increases, I think it's worth discussing what they are, how they may impact you. So for more information, you can see there's a link in the notes below to the actual proposed legislation, which has been dubbed Responsibly Funding Our Priorities, again, put forth by the House Democrats. There's also a summary that the House Ways and Means Committee put out summarizing all of the few dozen areas of increase that are in this legislation. There's also a link to that below. And finally, I just recently completed my own personal summary of some of the key points of the proposed changes. Specifically, I only commented on those that are most likely to impact individuals and or retirement planning. I didn't mention any of the corporate aspects or the other handful of seemingly random one-off changes that they're proposing. It's really just things most likely to impact individuals and retirement planning. So again, see the link below for a free copy. You don't have to put in your email or anything. Free copy of my summary of those proposed changes. So without further ado, I'd like to get into some of those proposed changes that I summarize. Again, those that I think are most likely to impact individuals and or retirement planning. Nothing to do with the corporate tax increases. First one is a proposed change in the top federal income tax rate. So currently, the highest marginal income tax rate is 37%. It is already scheduled to go back up to 39.6% in 2026 upon the preset expiration of the Tax Cuts and Jobs Act. The proposed changes now would make the top tax rate 39.6% now, well, technically effective in 2022, as opposed to waiting until 2026. So not a major surprise, not a major shock. What is different, however, is the income level at which that top tax rate will apply. Again, going back to Biden wanting to focus the increases on quote-unquote high income individuals, this legislation clearly defines what's high income. Specifically, it's married filing joint couples that have $450,000 or more of taxable income, or single filers that have $400,000 or more of taxable income. Keep those numbers in mind, because that's sort of the that's the defining characteristic of what it means to be high income for purposes of these proposed changes. So not only will the highest tax rate go from 37 to 39.6%, but it'll kick in at those high income levels. Like I said, 450 or plus of taxable income for married couples, 400,000 or more for single filers. And again, these will be effective in 2022 if passed as proposed. So no major surprise there, not to be too taken back. The other big one is increase in the top long-term capital gains tax rate. So currently, the highest tax rate that applies federally to long-term capital gains is 20%. So long-term capital gains are when you sell something that you've held for more than 12 months. That gain is taxed as long-term capital gains as opposed to as ordinary income. And the max rate currently is 20%. Biden had originally proposed or discussed increasing it to, I want to say 39.6%, give or take. I could be wrong. The point was, nearly doubling the long-term capital gains tax rate, the highest long-term capital gains tax rate. This proposal now would increase it to 25% from 20%. So, not great. It's an increase, but still significantly better than what Biden had originally proposed. And again, the income level at which this higher tax rate would come into play, this higher capital gains tax rate would come into play, would be for the quote unquote high income individuals. So again, that's 450 of joint taxable income or 400,000 of single taxable income. The other thing to note is the timing of when this would take effect. It would be effective for any sales that took place on September 14th, 2021 or later. I'm making this video September 16th. Yes, that's correct. This change would be retroactive to any sale activity September 14th, 2021 or later. Now, if you had something under contract to sell where you started, you entered that contract before September 14th, but you have not yet closed on that sale, you'd still be under the old, the existing 20% max capital gain tax rate. It's only for sales that are initiated September 14th, 2021 or later. Now, some people may not like that this change is retroactive in effect, as opposed to saying, okay, starting 2022, all long-term capital gains are taxed at this new higher rate. After thinking about it, I actually like that this is retroactive, and here's why. Because if the government were to come out, if the law were to come out and say, starting in January of 2022, all sales that are long-term capital gains will be taxed at a higher rate, what's going to happen? Well, the next few months, there's going to be a flood of selling activities of stocks, bonds, mutual funds, ETFs, whatever, real estate perhaps, other investable things. That's not good. I think that wave of selling activity could be the trigger that tips off, the possible eventual massive correction of the stock and bond markets. So I actually like that this increase in capital gains tax rate is retroactive. That's just my opinion. But next, there would be an additional 3% flat tax rate on top of all the other, income tax, capital gains tax, whatever. An additional 3% tax rate on the ultra high net worth or ultra high income folks. That ultra high income is defined as $5 million of modified adjusted gross income if you're married, filing joint, or single, or $2.5 million of modified adjusted gross income if you're married, filing a separate return. So for any amount of adjusted gross income over those levels, there'd be an additional flat 3% income tax levied upon all such income. That would also go into effect the 2022 tax year. So that's kind of it for the individual income tax rate increases that you're most likely to see. There's some other smaller things again, but I don't think it's necessarily worth noting for the majority of folks. So other big changes were regarding retirement accounts, retirement plans, IRAs, Roth IRAs, employer retirement plans. Sticking the same vein of focusing these changes, these increases on folks that are of higher net worth or higher income, they would institute a limit such that if you're high income, again, so $450,000 or more of taxable income if you're married, filing joint, or $400,000 or more of taxable income if you're single. So if you're high income and your aggregate balance across all of your retirement accounts, so that's IRAs, Roth IRAs, 401ks, 403bs, 457 plans, TSP if you're a federal employee, any annuities you have, the aggregate balance across all those, if it exceeds $10 million, you will no longer be able to contribute to your IRAs or Roth IRAs. Now here's the rub. There doesn't seem to be any mention of restricting your contributions to 401ks, to annuities, but if you hit that 10 million threshold across all those accounts, it's specifically just your IRAs and Roth IRAs you can no longer contribute additional monies to if you are a high income person. For what it's worth, if you inherit money and that puts you over the 10 million, that's okay. Or if you get some money from a spouse you're divorcing, under a divorce settlement, you get some retirement account money that puts you over 10 million, that's okay as well. It's just you can't do additional contributions into your IRA or your Roth IRA if you're high income and your account balances hit that $10 million limit. These would also go into effect for the 2022 tax year. With that in mind, there would now be required minimum distributions, aka RMDs, if and when your retirement accounts exceed that $10 million level. So regardless of your age, if your aggregate retirement account balance exceeds $10 million, you would be required to pull out 50% of the excess. So for example, you have $11 million across all of your IRAs, Roth IRAs, 401ks, whatever, $11 million, you'd have to pull out 50% of $1 million So in other words, you have to pull out $500,000 of income from those accounts to start trimming you back down to 10 million. So again, that's regardless of age. Because that will be required, there is no 10% early withdrawal penalty. So normally you can't take money out of tax deferred accounts prior to age 59 and a half without there being a 10% penalty. Well, that penalty wouldn't exist. You'd still have to pay tax on the income, assuming it's pre-tax, but the 10% penalty is waived regardless of your age in this case. Second wrinkle to this, take it a step further. If your aggregate retirement account balance exceeds $20 million, well, then you need to have you need to take 100% RMD of any amount over that $20 million to get you down to 20, and then 50% RMD on the amounts between 10 and 20, or at least that's my reading of it. This was a little fuzzy trying to digest what exactly you're getting at here. And one other thing to keep in mind here, if you do exceed this $20 million of aggregate retirement account balances, the RMDs first need to come from Roth assets. So either Roth IRA or Roth employer plan, like a Roth 401k, Roth TSP, Roth 403b. At least that is my wording of it. So these changes would also take place starting in the 2022 tax year. Next, for retirement accounts. So Roth conversions would no longer be allowed for high income individuals starting in 2032. Yes, 2032, 10 years away from now. Again, so high income, married over 450K of taxable income, single over 400K taxable income, that makes you quote unquote high income. If you're high income, you will not be able to do any Roth conversions starting in 2032. One other thing I should mention, so these high income thresholds I've been mentioning, 450K for married, 400 for single, these will be indexed for inflation. So every year they'll go up a little bit that there's inflation. They're not indexing in 2022. The amounts stay fixed in 2022, but starting in 2023, that 450K and 400K high income threshold will index up a little bit every year with inflation for all these provisions I just mentioned, or at least that's my understanding of it. The other Roth conversion one, so backdoor Roth contributions will no longer be allowed for anyone starting in 2022. So what does that mean? Currently, if your income is over a certain level, you cannot directly contribute money into a Roth IRA. However, anyone could do a backdoor contribution into that Roth IRA. The process for doing that is simply you have a traditional IRA into which you do a non-deductible contribution. Anyone could do a non-deductible contribution regardless of income as it stands now. Once you do that contribution into your traditional IRA, you can then convert it into your Roth IRA, thereby getting money to your Roth IRA through the proverbial back door. That is going away. Specifically, what they're taking out is the ability to convert after-tax or non-deductible monies. No one will be able to convert after-tax or non-deductible monies starting in 2022. That applies whether it's an IRA, so non-deductible contributions to your IRA, or even employer plans. If your employer 401k, for example, allows you to do after-tax contributions into it, you will not be allowed to convert those after-tax monies to the Roth account within your 401k. Again, this would apply to everyone starting in 2022. Two other changes to mention: the reduction of the unified credit, aka the estate tax exemption amount. So as it stands now in 2021, there's an $11.7 million per person, what's called the unified credit. That simply means you can give away up to $11.7 million during your lifetime without having to pay any tax on that. If you gift more than that during your life, then you have to start paying a gift tax on the excess over $11.7 million. This $11.7 million is not just for giving away money in life, it's also for giving away money in death. It's a combined, that's why it's called the unified credit. So when you die, if the value of your estate is more than $11.7 million in 2021, there's a federal estate tax. Any estate amount larger than $11.7 million is subject to an estate tax. That level was already scheduled to get dropped in half in 2026 as part of the Tax Cuts and Jobs Act. It was already pre-agreed to drop back down. What will be happening now is simply it's just expedited. That halving of the unified credit will go into effect in 2022 as opposed to wait into 2026. So not a major change here, just sort of speeds up something that was already going to happen. One other minor thing I thought was worth mentioning is the expansion of the wash sale rules. So what's a wash sale? A wash sale is if you own something in a taxable account, taxable brokerage account, so not an IRA, not a Roth IRA, for example. You own something, it's at a loss. So it's currently valued less than where you bought it, and you sell it, you're gonna have a loss in that position. Generally speaking, that loss is tax deductible. However, if you buy back that same thing or something that's substantially identical to that thing, if you buy it back either 30 days prior to your sale or 30 days after, it's called a wash sale. You can no longer deduct that loss. Instead, that loss gets tacked on to the basis of your new purchase. Currently, the wash sale rules are only written such that they apply to stocks and other traditional securities like bonds, I believe. What will be changing now is the wash sale rules would explicitly also include, digital assets, commodities, currencies, and digital assets will now explicitly be included in wash sales. Furthermore, and I'm not sure about my interpretation and reading the language, I couldn't quite make sense of it. You know how I just said you can't buy that same thing you sold within 30 days prior to the sale or 30 days after? It looks like that 30 days after is getting extended out to a longer period. Now I can't tell if they're extending it to just the end of the tax year in which you had the sale or the end of the following tax year in which you had the sale. Either way, it's clear that the wash sale rules will be changing, and these will go into effect in 2022 as well. So that's kind of it for the main changes to individuals and retirement planning in general. One other comment, one thing that's not in these proposals is the removal of step up in basis. If you recall, one of Biden's main tenets of his tax proposals was to reduce or remove step up in basis. And step up in basis is simply if you own non-qualified assets, so things not in an IRA, not in a Roth IRA. So you own a house, you own stocks and bonds in a brokerage account, you own land, you own a family farm. Currently, if you own that and die, the heir that gets that from you does not have to pay tax on the gain that was built up. So for example, 30 years ago, I bought shares in a stock for $1,000. That stock is now worth $100,000, right? It made a tremendous amount of money. There's $99,000 of unrealized gain, such that if I sell that during my life, I have to pay tax on that $99,000 of gain. Step up in basis is that if I take that to the grave, if I die still owning that stock and I pass that stock on to my kids, for example, and the stock's worth $100,000, they inherit it at $100,000 and that $99,000 of unrealized gain magically goes away. No one pays tax on it. I don't, because I'm dead. My estate doesn't. My kids who inherit it don't. The basis, meaning the cost at which my kids inherit it, gets stepped up. It's stepped up to the value of that thing on the day I died. So that's been around a while, and that's a tremendously powerful estate planning tool. That was on the chopping block, as per Biden's original proposals and wish list, if you will. Thankfully, there's zero mention of any changes to step up in basis in this proposed legislation, which I'm very happy about. So that's definitely worth mentioning. And that, other than that, generally speaking, I feel that at least the individual parts of this, not necessarily corporate parts, I didn't really dig into those, but the individual aspects of these tax increases aren't as bad as originally discussed. So if there is a silver lining to this gray cloud, if I said that right, it's that these changes that are actually now making their way through a bill, as opposed to just being talking points, are not nearly as punitive as originally posited and requested by President Biden. So that's that. Hope you found that helpful. Again, this is not law yet. This is just a draft bill. It's subject to change. Some things could be tweaked for better or for worse, or this whole bill can get scrapped completely. And politicians will have to start over drafting new legislation to put forth to the voting members. But nonetheless, the fact that this is now on paper in a real bill, I think it's worth giving more consideration to, because it's more likely, at least, that these things may come to fruition as opposed to just some vague general talking points that weren't actually put down on paper before. So that's that. Again, check out the links below for my summary of the changes I just discussed here, for the House Ways and Means Committee summary of all of the proposed changes in this bill, known as Responsibly Funding Our Priorities. Again, if you like this channel, definitely give a little thumbs up to this video, and please subscribe to the channel. Also, check out my Facebook group, Taxes and Retirement. You can get answers and education about all sorts of tax-efficient retirement planning techniques. And I got a newsletter too. Retirement Planning Insights. You can check that out on my website. Subscribe to that. It comes out every month. Lots of juicy retirement planning and financial planning stuff in there. All right, that's it. Thank you very much. I'll see you next time. Take care.